So many people repeat the same investing mistakes over and over again. It doesn't matter if they're just starting their journey or if they've been in the game for years. Time and again, investors fall into the same traps. Some never apply the lessons that the market teaches them, while others only learn after years of frustration and losses. What usually happens is this: they either stay stuck in the same place, never making progress toward building wealth, or they make choices that cost them dearly later on. That's exactly what this video is here to help you avoid. My goal today is to shine a light on the most common mistakes that drag investors down, while also giving you the knowledge to build a strong foundation for long-term growth. If you stick with me until the end, you'll walk away with a fresh perspective and practical strategies that can change how you think about money forever. These lessons aren't just theory. They're based on decades of market behavior, real-world examples, and hard data. So let's dive in and start with the first big lesson. Lesson 1. Markets are naturally unpredictable. This is one of the simplest truths about investing, but also one of the hardest to accept. Markets are not machines that follow a perfectly predictable pattern. They move in cycles, and with those cycles come corrections, downturns, and yes, even crashes. Think about it. A lot of people panic whenever the stock market drops by 5% or 10%, but here's the reality. Those dips are not rare accidents. They're a normal, built-in part of how markets function. On average, the market drops around 14% from its peak every single year before it eventually recovers. And history shows that despite these bumps along the way, the market ends the year in positive territory about 3 out of every 4 years. That means volatility isn't the exception, it's the rule. The problem is, when new investors see headlines screaming about a market crash, they often believe something is broken or that they need to get out immediately. But seasoned investors know better. Volatility is the price of admission. If you want the long-term gains the market offers, you have to accept the short-term discomfort that comes with it. So what does this mean for you? It means building a financial plan that works before, during, and after periods of uncertainty. If you're mentally prepared for downturns, you won't be shaken out of the market at the worst possible time. Lesson 2. Investing is not gambling. Now here's a mistake that trips up beginners more than almost anything else. Many people think of investing as no different from gambling. They hear stories about stock market crashes, wild swings in crypto, or people betting on meme stocks, and they assume the whole thing is just one big casino. But that's simply not true. Yes, both gambling and investing involve risk, but the type of risk and the way value is created are completely different. Gambling is a zero-sum game. If one person wins, another has to lose. And in the end, the house always wins. Statistics show that in US sports betting, fewer than 5% of bettors make money over the long run. Why? Because the odds are rigged against you. Investing, on the other hand, is ownership. When you buy a stock, you're not spinning a roulette wheel. You're buying a piece of a business that produces goods or services, earns revenue, and grows value over time. Historically, the S&P 500 has delivered around 10% annual returns on average. That return comes not from luck, but from real companies creating real wealth through innovation, efficiency, and growth. So while gambling is about chasing quick outcomes with no underlying value, investing is about patience, ownership, and letting compounding do its magic. But here's where investors, especially overconfident ones, still make a critical mistake: trying to time the market. Lesson 3. Don't try to outsmart the market. Even seasoned investors fall into this trap. They get a few wins. Maybe they bought Tesla at the right time, or they guessed correctly on a stock that doubled in value, and suddenly they feel like they've cracked the code. They think, if I just sell now and buy back in later, I'll double my returns. But timing the market is nearly impossible. To succeed, you'd have to be right twice. Once when you sell and once again when you buy back in. Miss by even a few days on either side, and you can lose out on massive gains. Here's the data. High trading activity, with constant buying and selling, actually reduces returns by 6 to 12% annually because of poor timing and transaction costs. Even professional fund managers rarely get both decisions right. Missing just the 10 best days in the stock market over a 20-year period can slash your overall returns by more than half. The better strategy is boring but powerful. Stay invested, stay consistent, and let compounding work its magic. Remember, it's not about beating the market day by day. It's about harnessing the long-term growth that unfolds over decades. Lesson 4. Don't chase last year's winners. This mistake is extremely common. Investors look at last year's performance, see which asset class or fund did the best, and then move all their money into it. But history shows that this approach almost never works. Take a look at the Callan Periodic Table of Investment Returns. It ranks asset classes year by year, and the picture it paints is clear. Winners rotate constantly. One year real estate is on top, the next it's at the bottom. Emerging markets might lead one year, only to crash the next. No single asset class dominates year after year. That's why chasing past winners is like driving by looking in the rearview mirror. You're always a step behind. The smarter approach is diversification. By spreading your investments across stocks, bonds, real estate, and other assets, you reduce volatility and smooth out returns. Diversification doesn't eliminate risk, but it makes your portfolio resilient. Lesson 5. Innovation doesn't equal profit. This one is especially relevant today. People often assume that just because an industry is groundbreaking, investing in it will guarantee wealth. But history shows otherwise. Think about the dot-com bubble of the early 2000s. The internet really did change the world. It transformed how we live, work, and communicate. Yet many internet companies of that era collapsed because their valuations were inflated far beyond reality. Investors poured billions into businesses with no revenue, no sustainable model, and no path to profitability. When the bubble burst, trillions of dollars evaporated. Fast forward to today, and we see the same excitement around artificial intelligence. AI will likely reshape entire industries, but that doesn't mean every AI company will succeed, or that buying into the hype now guarantees returns. Valuations, timing, and business fundamentals still matter. The truth is, almost nobody can predict which companies will survive and thrive. That's why it's wise to approach gold rush markets cautiously. Instead of betting everything on a single trend, focus on building a portfolio designed for long-term resilience. Final thoughts. We've gone through a lot of common mistakes that investors make: misunderstanding volatility, treating investing like gambling, trying to time the market, chasing past winners, and assuming innovation guarantees profits. So the real question becomes, what should you actually do instead of repeating these mistakes? The truth is, there's no magic shortcut, no overnight ticket to wealth, and no single stock or trendy sector that guarantees success. The answer is far simpler, but also far more powerful. It lies in building a balanced, diversified portfolio that spreads your risk across different asset classes, sectors, and even regions of the world. It means choosing investments that can weather storms, adapt to change, and still keep growing over time. And it requires one critical mindset: staying committed through every stage of the market cycle, whether it's soaring to new highs or plunging during downturns. Here's the reality: wealth is rarely built in sudden leaps. It's built in steady steps. It's about patience, consistency, and discipline. The willingness to keep investing when others panic, to stick to your strategy when fear takes over, and to trust the process when quick wins seem more tempting. Compounding, the most powerful force in investing, only works if you give it time. The longer you stay invested, the more your money works for you, multiplying quietly in the background until one day the results are life-changing. That's why the greatest investors don't chase fads or try to outguess the market. They focus on the bigger picture. They know that successful investing isn't about getting rich from a single move. It's about avoiding the big mistakes, staying consistent, and letting time and discipline do the heavy lifting. If you can avoid the pitfalls we've talked about today and keep your eyes fixed on long-term growth, you'll already be far ahead of the majority of investors who get caught in short-term thinking. So, what types of investments do we actually recommend? Which strategies can help you not just preserve your wealth but grow it in a way that supports your dreams, your goals, and your future security? That's exactly what we'll dive into next. Click here to continue your journey, and remember this: every choice you make today shapes the life you'll live tomorrow. Stay consistent, stay patient, and keep moving toward your own great, big, beautiful tomorrow.